Hello, and thanks for tuning in to this video on Introduction to Capital Structure. This video is part of a channel that I've established to share my experience over 5 decades in finance and accounting, written 3 books on finance and FP&A, and taught in numerous MBA classes on finance. So what I've developed here are short focus sessions on important topics. I've got 5 or 6 playlists shown there across a wide range of topics, FP&A, right down to capital structure and cost of capital. We're here today. Many of the illustrations and models that we're using are based on my latest book shown in the upper right-hand corner, Financial Management, should you want to pursue these topics in more detail. So today, this is the first introductory video in the capital structure, cost of capital, and financing playlist. And we're going to talk about what capital structure is, what financial leverage is, how it impacts financial performance. We'll talk about how we analyze capital structures, short-term versus long-term financing and liquidity, and then we'll summarize and move forward to the other topics. I have the quote there from Hemingway, how did you go bankrupt? 2 ways, gradually, then suddenly. And what he's referring to, of course, is that leverage can be a powerful asset, but it can also be the beginning of the end for many companies and individuals as well. So let's talk about the capital structure and cost of capital. Managers have 2 objectives really to create value, which they're mandated to do as agents for the firm. The first one is to select projects that create value. And the second one is to finance the firm in an optimal way that leads to maximum value creation. The cost of capital is an integral tool in finance. It represents the hurdle rate for projects, and it also is a measure of the financing mix in the second objective. So managers create value when they earn a return in excess of the firm's cost of capital. As a result, it's a key driver in value creation, and reducing the firm's cost of capital increases the value of the firm. And there are many factors that influence where we set the cost of capital and the capital structure. So the sources of capital simplified here. This is a table from the book that we'll be using as the source for the data. And I've mentioned in other videos in analyzing financial statements that I really like to reorder the balance sheet as shown on the right. So if I have the traditional assets on the left, liabilities and equity on the right, I'm going to rearrange them so I pull the operating liabilities under the assets, and that leaves me with net assets, net operating assets on the left-hand side, and it leads me with invested capital, or the sources of capital, on the right side. So this winds up being a much easier way to think about the balance sheet and to think about the assets that are required for the business and then how we're going to finance them. So in terms of short-term liquidity and financing, and we'll have another video on operating capital management, but short-term liquidity and financing basically deals with enabling the firm to deal with seasonal patterns and variations and day-to-day working capital requirements. So it considers things like cash flow and reserves of the organization, revolving credit agreements where they can draw down to cover any shortfalls at any point in time. Larger companies can issue commercial paper to satisfy short-term requirements, and then obviously short-term loans as well. So this is all because the cash cycle says that we have some cash, we need to spend it to acquire inventory or to build something or to provide some service. Then we're going to pay those bills, a cash outlay. We're going to provide a service or deliver product to customers, but there's going to be a lag between that rendering of this service or product and the collections of customers. So we need to find a way to finance that typical deficit in the cash cycle. In terms of long-term capital, this is really where we're financing the long-term capital requirements of the organization. There are basically three broad types or sources of capital. The first and easiest to understand perhaps is debt. Things like bank loans, bonds issued to the public, commercial paper, long-term leases are essentially a borrowing instrument. And these are characterized by being a fixed claim on the company. In other words, you have to pay periodic interest, and you have a sum due at some point in time in the future. Debt holders have a priority claim on the earnings of the firm, that is, in advance of equity or common shareholders. The payment of interest is generally tax deductible, and they don't have really any voice in running the corporation. They can't vote on board members, they can't vote in proxies. The other end of the spectrum is equity. Common stock, of course, has the lowest priority claim. It's a residual claim after the other priority claims, such as debt repayments and interest, are paid. The dividends that are paid on common stock and share repurchases are not tax deductible. Equity has an infinite life compared to the finite life of debt. And there is an element of management control in that shareholders can vote in proxy statements for a new slate of board of directors or on certain measures that the company puts forward. And that leaves us with hybrid securities in the middle. And they represent basically a blend or characteristics of both debt and equity. Common examples would be convertible bonds, preferred stock, and warrants. So in terms of long-term financing, some of the most common elements are term loans. These would have 5 to 7 year life, and the balance would be due at the end of the term. Very common financing vehicle. Private placement bonds would be similar to term loans with longer durations. It's called a private placement because the organization, generally larger organizations, would be able to go and negotiate with a lender such as an insurance company or even a consortium of banks. Then there's bonds issued to the public, and these would be the bonds that we could buy in the capital markets. It allows companies to access the public capital markets. It requires a significant process. So where the bank or the insurance company might be involved in the first two types of loans, here, because we're offering these to the public, we have to go through a registration statement, filing with the Securities and Exchange Commission in the U.S., and it has to be marketed then to the public. There's also special purpose financing. For example, if you were constructing a large facility or building a large plant, or even product for inventory, for example, an aircraft or a large ship, you might obtain special purpose financing that was dedicated and also secured by that specific project, and therefore might get more favorable terms. So we talked about the hybrid securities a bit. It combines elements of stock and bonds. And what's important here is that the security will have the guaranteed payment nature of a bond while also having the potential for capital appreciation on the stock. For example, if the convertible bond is exercised and converted to stock. In terms of securitization, oftentimes ahead of common stock. And the presence of the equity upside generally results in more favorable interest rates for the issuer, for the firm. The two most common types are convertible bonds and preferred stocks, and the valuation of those securities recognizes the combined features. So there will be an element of valuing it as a bond and an element of valuation as equity. So some of the measures that we look to whenever we're analyzing capital structure and financial leverage are listed here. Debt to total capital is my favorite in this area, and you basically look at the interest-bearing debt divided plus divided by equity, essentially. So what we're going to do is take all interest-bearing debt, and we're going to divide that by debt and equity, excuse me. And so this is the proportion of total capital that's provided by debt, in this case 15.4%, a relatively modest amount. Another related measure is debt to equity, which just looks at the ratio of debt to equity, and sometimes I find that a little harder to process and use in things like developing the weighted average cost of capital, where the debt to total capital is easier to understand and to use in those computations. Times interest coverage, or variations of that, basically look at the income generated by the operation divided by the interest expense. And in this case, we would say it's 25 times interest coverage is the income. And at that level, it would represent that the organization has a lot of slack, if you will. In other words, they could borrow more and fund greater interest expense levels, or they could survive some hit in operating earnings and still be able to cover the interest expense. And financial leverage is a term that's used generally to describe the capital structure and the use of debt in the capital structure, but it's also a component in return on equity, and it's an important driver and actually can have a huge impact on the return on equity, as we'll see in a moment. So these ratios are used in the C-suite by board of directors, shareholders, and also credit and bond rating agencies. So on the financial leverage, especially as it applies to the return on equity, it represents the use of borrowed funds to finance a company's operations and cash requirements. It enhances equity returns because it reduces the amount of equity that's required to generate operating income and profits. But it also increases financial risk. That is, as you increase the amount of debt or the financial leverage level, you will increase financial risk. And as shown on the right-hand side there, we've got a very simple comparison of LSA, which we used in the previous slides, to a highly leveraged company there. They have the same asset structure, the same level of income generated by operations, but we'll see that we've got a very different result in terms of the return on equity. It's going from 17% to 32%, just because they have a higher mix of debt versus equity in their capital structure, as shown in the center of that chart. So the financial leverage here goes from 1.43 to 3.01. So financial leverage will increase equity returns when used in a judicious and appropriate level. So I mentioned credit rating agencies. These agencies differ from equity analysts, who are more focused on the equity upside, the potential appreciation of this stock. The credit rating agencies are focused on the ability of the issuer, the company, to repay the debt and to service the debt, pay interest expense over the term of the financing agreement. So they assess the credit worthiness of the debt issues, and they use very different metrics and methodologies than the equity analysts do. So we see on the bottom a rating scale. The credit rating agencies generally will publish a rating, and these are different depending on which credit rating agency you're referring to, but they usually will start off with highly investment rated grade bonds, and they would be AAA or AA or A, and then junk bonds, speculative bonds, those that have more risk, would be off on the other end of the spectrum and might get something like a low B or D grade. And of course, the interest rate that is driven by these will vary significantly. This is called the credit spread. So the highly rated companies and bonds would be able to command a lower interest rate than those that were highly speculative or junk. Investors would want to have a greater interest return because of the law of risk and return. The higher the risk, the greater the return. So the process the credit rating agencies go through is they periodically review, generally once a year, the performance of the company and look at the balance sheet. And this would include a meeting with the CFO, sometimes the CEO, the treasurer, and they would get an update on the company's performance and have a chance to ask questions. They might also trigger a review on an event-driven basis. For example, if the company announces a large acquisition or lose a major contract, then they would put them under review is the term, and then have another meeting and analyze the company's overall ability to pay its obligations. So the considerations there, again, a little different than equity. What's the risk of default? A focus on cash generation, debt service coverage, how conservative or aggressive is management and the board? What's the business and market? What are the risks involved? Is there cyclicality in this business? And what are the future investment requirements? So capital structure also varies significantly based on the organizational life cycle. So we know when a company starts out, it needs a lot of cash to fund its operations. It might not even have any revenue or just modest revenue. So its cash requirements are high. And then as the organization's growing, it still needs to have a lot of cash to support expansion, to support working capital requirements, and to fund the growth in the organization overall, continued investments in R&D. And then it reaches a point where the growth slows down and eventually stops for many firms, reaches a mature state where it doesn't need as much cash. It's not any longer in the borrowing position. It might actually be spending its time trying to determine how we should best utilize the excess capital we have, perhaps acquisitions or other investments, or return it to shareholders in the form of dividends, share repurchases, special dividends, etc. So we'll talk about financial policy in another video, and that would cover that. But again, the takeaway here is that the capital structure and financing requirements will change over time as the organization moves along that life cycle maturity curve. So the cost of capital mentioned earlier, it's an important value driver, and it also is the basis that we use to evaluate capital investment decisions that we're making. So we're going to discount those expected cash flows on projects based on our weighted average cost of capital and additional adjustments to that risk level for the specific project. And we've got a series of videos in another playlist on that, on capital investment decisions and valuation. But I just wanted to show here that the factors that drive the cost of capital, financial leverage or the capital structure is one of the key ones, as well as market interest rates, operating leverage, volatility, and risk. So financial theory holds that there is an optimal capital structure for an organization, and that if we were financing the operation strictly on equity, that is only by issuing common stock and had no debt, our cost of capital would be high, as shown on the y-axis there. As we begin to introduce debt, which generally has a lower cost of capital, it would lower the overall weighted cost of capital, and at some point in time we would introduce enough that we'd result in the optimal level, the optimal capital structure that would have the lowest weighted average cost of capital. And again, we'll get into more of this in the video on the weighted average cost of capital. However, if an organization introduces too much debt, if it takes on too much leverage, it will actually subject the firm to more risk and would increase the expected return on the debt issued, but also on equity, and the overall weighted cost of capital would increase. So companies are always aware of this theory and have it in the back of their mind in terms of maximizing value, value creation, and the value of the firm. So with that optimal capital structure theory in hand, why don't most corporations operate at that optimal capital structure? Well, there's a number of other factors that come into play here. What's the strategic objective of the firm? What are the cash requirements? Are we maximizing value? And what is the view of the board, the CEO, and the CFO about the use of capital and the use of debt in the capital structure? What life cycle stage are we in? We discussed. What's the organizational culture? Are we risk averse? Have some of the board members or the CFO been involved with highly leveraged enterprises that didn't end well? That would certainly frame how they view where we ought to be on that spectrum of debt versus capital. Practical considerations, wanting to maintain some flexibility. The market conditions obviously have an impact, but all those factors would be taken into account, and then companies would often come up with a target capital structure and a financial policy of where they prefer to operate. So that targeted capital structure might be expressed as saying we want to have debt be 30 to 40% of the total capital structure. And then over time, it will be modified based on operating performance, economic cycles, interest rates, the equity valuation, strategic opportunism. That is, the company may wish to do a large acquisition. It might deviate from their target capital structure for a time. And all these things weigh into the actual capital structure at any given moment. One of the other factors that comes into play here is the need or the desire to maintain some flexibility for future financing requirements. So there may be planned or opportunistic investments that we may want to contemplate in the future. And so we don't want to go and max out our borrowing capability and not be able to take advantage of increasing our investment in new product development or buying an acquisition. We also, of course, want some flexibility should there be any negative surprises or downturns. So this is another calculus that goes into the setting of the capital structure. So I'm a fan of dashboards, and I like to look at capital structure from a key performance indicator standpoint. And so this one, again, has both elements of leading and lagging measures. So the lagging measure here is the debt to total capital in the upper left-hand corner. And the purple column shows the target range, and it shows where our actual debt to total capital is compared to our target. We've got a graph in the upper center, which is the weighted average cost of capital over time. The upper right-hand corner is the return on equity, and as we would expect, that's increasing as we have increased the level of debt in the capital structure. Then we've got financial leverage, which is the component or the mechanism that drives the change in return on equity, times interest coverage in the bottom center. So we're showing that we're decreasing the coverage there over time, but it is still very strong. And then we include that financing flexibility, so we continue to present to the organization and the board where we stand in terms of future financing flexibility. So in summary, financing the corporation is an important value driver and ensures resources to fund the needs of the company. Short term looks at the day-to-day funding requirements, addressing seasonal fluctuations and working capital requirements. The capital structure and long-term financing provides the capital to support the long-term funding requirements of the firm. And cost of capital is directly related to the capital structure. And again, it's important to step back and recognize that that represents the rate of return expected by investors in the firm. And we've got another video going into a deeper dive on that subject. So setting the financial policy, implementing the strategic capital structure, and providing for the short-term financing requirements are really critical responsibilities of finance, but also the CEO and the board of directors. And I invite you to watch the other videos on the playlist and also on the channel. So thanks for joining us on this video. If you liked it, please hit the thumbs up button and subscribe to the channel. And I wish you all the success in your financing careers. Thanks.